Welcome to Tech Money Madness Weekend Edition, your bite-sized investor education series. Today's topic, the yield curve, recession crystal ball.
Yeah, it's one of those terms you hear constantly.
Right. Imagine a single metric that has supposedly predicted almost every modern economic disaster. From the dot-com bust to the 2008 financial crisis, all just by comparing two interest rates.
It's wild when you frame it like that.
It really is. It's this metric that flashes across financial news screens with, extreme gravity, yet it's rarely explained beyond just superficial jargon.
No, absolutely. People just throw the term around.
Exactly. So today, we are tearing it down to the studs. We're looking at what is actually moving the numbers, how institutional investors strip these curves apart, and why treating this line on a graph as some inevitable prophecy might be the most dangerous thing you can do with your portfolio.
I'm really glad we're doing this deep dive. It is arguably the most critical dashboard indicator in modern finance, but to your point, it is vastly misunderstood.
Yeah, totally.
People treat it like a magical oracle, right? They completely ignore the mechanical, real-world trading forces that actually cause it to change shape.
Okay, let's unpack this, starting with just the fundamental definition. Because if you look at Investopedia, they define the yield curve as a graphical representation showing the relationship between yields, meaning interest rates, and the time to maturity for comparable debt securities.
Right, which sounds very textbook.
Super textbook. But basically, usually when analysts say the yield curve, they're referring specifically to the U.S. Treasury curve, right? Like for government bonds.
Exactly. We are looking at what it costs the United States government to borrow money over different timelines.
Like from a few months out to, 30 years?
Yeah, exactly. Up to 30 years. And traditionally, people use this analogy of a parking garage or a bank CD menu to explain this to you. The longer you park your car, the more you pay.
Right. That makes sense on a basic level.
Yeah. Or, in the case of a bond, the longer you lock your money away, the higher the interest rate you demand in return. So the price changes based on the time commitment.
I always found that parking garage analogy a bit, inadequate, though.
Oh, really? How come?
Because it completely misses the active trading mechanism of the bond market. You don't trade parking tickets based on global macroeconomic sentiment, right?
Yeah, no, you definitely don't. That's a fair point.
So I think a better way for you listening to visualize this is to imagine a massive open-air commodities market where people are buying and selling contracts for future deliveries of cash.
Ooh, I like that.
Right, because if you're buying a contract that pays out in, say, 3 months, the price is largely anchored to whatever the central bank is doing right now.
Yes, the immediate reality.
But if you are buying a contract that pays out in 10 years, you are trading on pure future uncertainty. You have to factor in long-term inflation, geopolitical stability, economic growth, all of it.
That is a much sharper way to frame it, because it really highlights that friction between the present and the future.
Exactly.
And, that friction is exactly why you should care about the borrowing rates of the U.S. government, even if you never intend to buy a single Treasury bond in your entire life.
Which a lot of people don't. But they still need to care.
Right. Because the U.S. Treasury curve acts as this gravitational pull for the entire global financial system. It represents the baseline risk-free rate of return.
Because if the U.S. government, which, let's remember, can literally print its own currency, is offering a guaranteed 4% return for 10 years, no rational investor is going to lend money to, a risky tech startup.
Exactly. Or fund a 30-year mortgage, right,
Yeah.
unless they get significantly more than that 4%.
Precisely.
So every other financial instrument is priced at a premium above that baseline Treasury curve. It dictates consumer mortgage rates, corporate borrowing costs, and even the valuation models used to price the stock market.
Wow, so it really is everything.
It is. So when this curve starts behaving strangely, it sends shockwaves through every asset class on Earth. It's a critical window into the direction of the economy.
Which brings us to the famous term spread,
Yeah.
right? The mathematical summary of that curve's slope. And since this line can influence stock prices and predict recessions, we really need to know how to read it.
We do. And to construct the graph, you literally just plot the yields of bonds against their maturity dates.
Okay.
And depending on the economy, this creates different shapes. You get upward sloping, downward sloping, which is the inverted one people panic over flat, or even hump shaped.
Okay, but there are dozens of different Treasury bonds with different maturity dates. Our research notes that the New York Federal Reserve uses a very specific convention to summarize the slope, right? to take the economy's temperature.
Yeah, they do. They look at the term spread, which is the difference in yield between the 10-year Treasury bond and the 3-month Treasury bill.
But why those two specific goalposts?
Well, what's fascinating here is how perfectly those 2 points capture the structural tug-of-war in the financial system.
The present versus the future.
Exactly. The 3-month Treasury yield is heavily tethered to the present moment. It is almost directly controlled by the Federal Reserve's short-term policy rate.
Right.
The 10-year Treasury yield, however, is floating out in the free market. It is dictated by the collective expectations of millions of global investors regarding long-term growth and inflation.
So when we calculate the term spread by taking the 10-year yield and subtracting the 3-month yield, we are literally subtracting the reality of today's monetary policy from the market's hope for the future.
That is exactly what you are doing. And in a healthy, growing economy, the long-term future is riskier, but offers higher returns.
So give me a concrete example of the math here.
Sure. Let's say the 3-month bill yields 2% and the 10-year bond yields 4%. You have a positive term spread of 2%.
Okay, so the curve slopes upward.
Right. Investors are being rewarded for taking on the long-term risk of funding future growth.
But if I'm looking at a live trading terminal and I see that spread start to collapse, let's say the 3-month yield jumps to 3% and the 10-year yield falls to 3.5%, leaving a spread of just 0.5%, what is actually mechanically happening on the trading floor to cause that flattening?
That's the million-dollar question.
Right, because we often talk about the curve moving as if it's weather, but it's driven by human action. Who is moving the line?
The mechanics come down to supply and demand, driven by anticipation of interest rates. Let's look at the lead up to the 2008 financial crisis as a historical case study.
Oh, perfect. What happened there?
In the mid-2000s, the Federal Reserve started aggressively raising short-term interest rates to cool down a red-hot housing market. Because the Fed controls the short end of the curve, that pushed the 3-month yield significantly higher.
Okay, so the central bank is actively forcing the short end up. But why would the 10-year yield fall at the exact same time?
Because the institutional investors, the massive pension funds, the sovereign wealth funds, looked at those rate hikes and anticipated that the Fed was going to choke the economy into a recession.
I see where this is going.
Fearing a collapse in the stock market and corporate earnings, those massive pools of capital sought out the ultimate safe haven, long-term U.S. government debt.
Wow, okay, so there is a massive stampede of buyers rushing to purchase 10-year Treasury bonds to hide their money for the next decade.
Yes, and basic economics dictates that when demand for an asset skyrockets, its price goes up.
Right.
But in the bond market, price and yield move inversely. So as everyone scrambled to buy the 10-year bond at any price, they drove its yield plummeting downward.
That completely demystifies the inversion. I mean, it isn't a mystical prophecy at all.
Not all.
It is the literal intersection of a central bank suffocating the present with high short-term rates, while terrified institutional capital flees to the safety of long-term bonds, driving long-term yields down.
Yeah.
The 3-month yield crosses above the 10-year yield, and boom, the curve inverts.
That is the exact mechanism. You have central bank policy pushing up the short end and a flight to safety pulling down the long end. But there's a third, slightly more abstract driver we have to factor in here.
No, what?
Analysts call it the term premia.
Right, I saw that in the sources. Term premia. It sounds like an insurance term, honestly.
It essentially is. Term premia is the extra compensation the premium investors demand strictly for the uncertainty of time.
Okay, break that down for me.
When you lend money for 10 years, you face the very real risk that unforeseen inflation will erode the purchasing power of your money before you get it back, or that interest rates will spike, leaving you trapped in a low-yielding asset.
So term premia is basically the anxiety tax.
I love that. Yes, the anxiety tax.
It is the extra yield you demand because you are giving up the agility to pivot if the world changes over the next decade.
Precisely. And what makes this so critical for analysts is that term premia can fluctuate wildly independent of actual economic growth.
Really? Just based on vibes?
Basically, if global uncertainty is low, term premia shrinks, which can flatten the yield curve even if a recession isn't imminent. It is a highly sensitive gauge of institutional comfort.
Well, here's where it gets really interesting, though. We have been analyzing the standard yield curve, the one plotting standard Treasury bonds, but the sources we reviewed reveal a whole underground ecosystem of alternative curves.
Oh, yeah. It goes so much deeper.
Right. Financial engineers don't just use one simple line. They tear the data apart to create things like the spot curve and the implied forward curve.
They do, because the standard par yield curve, which is the one you see on the evening news, actually has a mathematical flaw if you are a high-level quantitative analyst.
A flaw? What do you mean?
A standard 10-year Treasury bond pays you a coupon, right? A little bit of interest every 6 months.
Right, you get cash flow along the way. You don't just wait 10 years for a single lump sum.
But that cash flow creates a problem called reinvestment risk. If you get paid interest in year 3, you have to find a place to invest that new cash at whatever the prevailing market rate is in year 3.
I see.
That muddies the purity of the 10-year yield because your total return depends on future rates you can't predict.
So how do they fix that? How do you isolate the pure yield of money locked away for exactly 10 years with no messy intermediate payments?
You build a spot curve, also known as a zero coupon curve.
Okay, how does that work?
Financial institutions literally take a standard Treasury bond and legally strip the coupon payments away from the principal repayment.
Wait, really? They just rip it apart?
Legally, yes.
Hmm?
They sell the coupons as separate, distinct investments, and they sell the final principal repayment as a zero coupon bond. It pays absolutely nothing until the very last day of year 10.
That is fascinating. You are physically decoupling the asset to remove the reinvestment variables. So a spot curve is a much cleaner, sterilized laboratory environment to see exactly what the market demands for a specific, uninterrupted duration of time.
It strips away the noise. And once you have that clean spot curve, you can calculate the other major analytical tool you mentioned, the implied forward curve.
Now, this one sounds like actual financial fortune telling.
It does, doesn't it?
Yeah, I mean, the implied forward curve maps out what the market expects short-term rates to be at specific future dates. But I want to challenge this. How can a mathematical formula possibly predict what a central bank will do 2 years from now?
Well, that is the beauty of it. It isn't actually predicting the future. It is just balancing a mathematical equation in the present to prevent arbitrage.
Okay, explain that arbitrage mechanism. How does the math force this curve into existence?
Let's say you have a choice. You can invest your money in a 2-year zero coupon bond yielding 5%.
Okay.
Or you could invest in a 1-year zero coupon bond yielding 4%, and then when that matures in a year, roll that money into a new 1-year bond.
Okay, so I'm choosing between a single 2-year lockup or 2 consecutive 1-year lockups.
Right. For those 2 strategies to be financially equal, there is only one specific interest rate that second 1-year bond can possibly have.
Oh, I see. It has to balance out.
Exactly. If the market rate for that future 1-year bond is too high or too low, a massive hedge fund will instantly borrow money on one side of the trade and lend it on the other side, locking in a risk-free profit.
I see. So the implied forward rate isn't the market looking into a crystal ball and guessing the future.
Not at all.
It is simply the missing puzzle piece that balances the current yields of overlapping maturities. The market isn't forecasting, it's mathematically closing loopholes.
That is a brilliant distinction. Yes, implied forwards are mathematically derived necessities, not necessarily prophecies.
Okay, but if this is all just a mathematical balancing act driven by arbitrage, supply and demand, and current central bank policy, then calling it a recession crystal ball feels dangerously misleading.
It can be.
So what are we getting wrong when we treat this indicator like absolute certainty? Like, if the curve inverts, should you listening immediately panic and assume a recession is guaranteed?
If we connect this to the bigger picture, the absolute worst pitfall for an investor is treating the yield curve as a mechanical switch. An inverted yield curve does not cause a recession.
Right.
It is merely a symptom of the structural conditions that often lead to one.
So it is the difference between a thermometer and a fever.
Yes.
The thermometer tells you the temperature is 102 degrees, but the thermometer isn't making you sick. The underlying infection, which in this case might be restrictive central bank policy or a credit crunch, is what actually makes you sick.
Exactly. And this perspective is heavily emphasized by the CFA Institute, the gold standard organization for investment professionals. They explicitly warn against looking at the yield curve in a vacuum.
Need context.
You have to contextualize it with broader monetary policy and other economic indicators.
Because an inversion means something entirely different depending on the environment.
Correct. if the yield curve inverts because inflation is raging at 8% and the central bank is violently hiking short-term rates to destroy demand.
Well, that is a classic recessionary setup.
Right. But if the curve flattens or slightly inverts simply because, say, foreign investors are buying our long-term bonds due to trouble in Europe or Asia, while the domestic U.S. economy is humming along with low unemployment.
Then that inversion might be a false alarm.
Exactly. The context of global capital flows matters immensely. It's a complex dashboard, not a simple crystal ball.
That makes total sense. You can't just read the single gauge, you have to read the entire dashboard. Are there any other major blind spots investors have when dealing with this?
This raises an important question about the one-size-fits-all myth. We have spent this entire deep dive analyzing the U.S. Treasury curve.
Right.
But a massive pitfall is assuming that curve represents the reality for every borrower in the economy.
Because borrowing money as the U.S. government is wildly different than borrowing money as an auto manufacturer.
Yes. The corporate yield curve looks fundamentally different than the sovereign yield curve. Even if the Treasury curve is perfectly normal and upward sloping, the corporate yield curve could be deeply stressed if investors suddenly fear a wave of corporate bankruptcies.
Oh, wow.
You have to look at the specific creditworthiness of the sector you are analyzing. Furthermore, you cannot apply the U.S. curve to international markets.
Right, different currencies.
The yield curve for Japanese government bonds, operating under decades of near-zero interest rates, behaves completely differently than the curve for German bonds.
So the localized currency and the specific central bank dictate the rules of that specific game. You can't use an American thermometer to measure the Japanese economy.
Exactly. The yield curve is highly localized to the market segment and the currency. Applying macro assumptions across different sovereign curves is a fast track to misallocating your portfolio.
So we have dismantled the parking garage analogy. We have explored how institutional fear drives long-term yields down. We have stripped bonds apart to find the spot curve, mapped out the arbitrage of the implied forward curve, and debunked the myth of the infallible crystal ball. So what does this all mean for you, the listener, navigating your own financial decisions?
I think the most vital takeaway is a shift in perspective. You have to stop viewing the yield curve as a static, theoretical chart and start recognizing it as a living, breathing ledger of global capital allocation.
A ledger of capital allocation, I like that.
It matters because it is the foundational baseline for the cost of money, dictating everything from your mortgage to corporate expansion. But it is not magic.
Right.
The term spread, that crucial difference between the 10-year and 3-month yields, is simply the collision point between the central bank's control of today and the free market's expectation of tomorrow.
And while historical data shows that a sustained inversion has reliably preceded economic downturns, you cannot trade off it blindly.
Absolutely not.
You have to ask why it is inverting. Is it restrictive monetary policy choking the short end, or a global flight to safety pulling down the long end? You have to contextualize the curve within the broader macroeconomic dashboard.
Exactly. And as we wrap up, I want to leave you with one final thought to mull over. We spent a lot of time breaking down the mechanics, the zero coupon stripping, the arbitrage equations, but think back to that concept of term premia.
The extra compensation investors demand for the unknown, the anxiety tax.
Right. Because term premia is essentially compensation for uncertainty, the shape of the yield curve isn't just a math equation at all.
What is it then?
When you look at that line flattening or inverting, you aren't just looking at yields and maturities. You are looking at a real-time psychological graph of human anxiety.
Wow.
It is a visual representation of how worried thousands of institutional fund managers are about the future of inflation, the future of growth, and the great unknown. I challenge you, the next time you see the yield curve flash on a financial news screen, don't just look at it as a percentage spread.
Look at it as a measurement of collective market confidence.
Or collective market fear.
A real-time psychological graph of human anxiety plotted in basis points. That is a brilliant way to conceptualize it, and it definitely changes how I'll interpret the financial news going forward. That's all for this weekend's Deep Dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.